I'll first start with the introduction of our speaker, Mr. Pranav Gokhale. He is a senior fund manager, equities at Canara Robeco Asset Management Company. He joined the AMC in November 23. He is a chartered accountant and has a master's in commerce. He has over 21 years experience across equity research and fund management. He comes with a strong background in fundamental company research, working with organizations like ILNFS, ICICI WebTrade, and Rosy Blue Securities. In his last assignment, he was with Invesco Asset Management, where he managed multiple schemes. At Canara Robeco, he manages more than 20,000 crores across mid and small cap fund. And he is also a co-fund manager for Canara Robeco Flexi Cap Fund. Thank you so much, Pranav, for joining in the call today and addressing our audience.
Thank you for having me around. A warm welcome to everyone.
So, Pranav, one major question that everyone have in the current market scenario is we have seen a strong market rally over the last 12 months, wherein if I look at the large caps, they have given almost 22% odd return, wherein mid and small caps have given more around 60 to 70% return in the last 1 year. And people are concerned about the market valuations, particularly in the mid and small cap space. So how are you looking at this particular space from your perspective?
Thank you. So this is a question which troubles everybody. We sometimes have got significant good returns, and now this has been over the last 2-3 years combined also, where we had all of us have made reasonable returns. Now, question to answer is what on from here on? So to answer this, I will run you through a few slides, in terms of how the various facets of markets are trading at, what we see, what has history taught us in terms of, or how does our payoff ratio stack out at the current juncture? And is there an opportunity in the current context? Do we see some opportunities? And if at all, where it is? I hope that is fine with you.
Sure.
Yeah. So just to give you a backdrop of how we have gone about as a country, well, returns have been exemplary, as I said. So now, again, so if we look at India's contribution to world GDP, we're closer to 4%. April 20, we were half of that. Clearly, we have started having our share in the global context. We've reached top 5 markets in the world. Clearly, in terms of the returns, so if I look at the world returns, which is on the slide on the top, and I see the change in the market cap for them, India has contributed significant chunk of the total GDP market cap addition to the overall world. You see, there are countries like US, there are countries like Japan, which are developing nations, which have done well. But India also has its own share, as you can see from here on. So clearly, where do we stack out from a global perspective? So I'm going to answer this from two perspectives. How do we stack up versus the global peers? How do we stack up versus our own? And the question which you asked in terms of mid cap and small cap. So if I look at market cap to GDP, which is there on the side, where we are vis-a-vis the equity risk premium, which is the risk premium which one assigns to the country based on the macro scenario or the geopolitical scenario. So while we are expensive to that extent vis-a-vis the world, we are not in an overtly expensive zone as we can see from here. There are certain countries which are even more expensive as a total market cap to GDP, or also if you consider the equity risk premium. So somewhere we are in between from the global context. If I have to give it to you in terms of the P ratio, now this is a slide which gives you. So India always used to trade at higher P vis-a-vis the MSCI, emerging markets. We're part of the emerging markets. Having said that, a significant higher P ratio has come up. This has come up because despite the market going up, our earnings have been very strong. relative to many other countries where earnings have been soft, India so far has delivered reasonable amount of earnings growth, and that is something which has actually helped this. So while we still trade at a premium to emerging markets, and the average premium was 77, today the premium is tad higher. It does definitely come off. Question everyone will ask is, while the markets have gone up and others have not, why has this premium come up? The answer is earnings. Earnings have contributed significantly to this. And this is the key point. This is the key important thing. If I look at Nifty valuations today, Nifty valuations on a price to earning or price to book. On a price earning basis, we are trading closer to the mean. There is a marginal premium to the mean. On a trailing price to book, we are trading at a premium to on a price to book basis for the Nifty as a whole. But if I give you the context of this uh, ROE for the Nifty, if you can see here, ROE for Nifty is at a cyclical high. While on a price to book basis, we do see Nifty at a premium. It is for a reason because earning growth is strong and ROE is reasonably healthy. So, uh, no, the analysis which is important and what is there is what happens when we are trading at that level. So, what I've done is I've extrapolated the last few years of returns, and if Nifty was trading at a particular level based on the trailing 12-month price earning ratio, what has been our median returns for an investor over 1, 3, 5, 7 years? Key point to note is while when we trade at premium multiples, the shorter term returns tend to be a bit soft. Okay? We are in this range of 22.7, 22.9, which is this range of 70 to 80% versatile. The returns in the past have been reasonable. Shorter term, one may get those swings, but if one is invested for a longer term period, one does make return. And this is largely led by earnings compound. Important point here to note is if you stay in the markets and the market's expensive, your duration need to increase, else the return potential tend to be softer in a very short period of time. So that is something one needs to understand. Mind you, these are median returns. There have been returns which have been much higher. There have been returns which are lower, which is why many a times you don't see negative returns. Now, if I take a bit more in terms of price to book and see what has been the returns during these price to book periods. Uh, over a 1 year period, if you see in this range, and here you're here closer to 3.6, uh, no, the returns over 1 year, 2 year basis have been a bit softer. I'm not just basing myself on one data point, but I'm taking a cumulative around this range. Over a medium term, we tend to get a decent return. Your entry multiple matter, and once if you're trading at a premium, your near-term returns might get compromised, but over a medium term, you do make returns. Uh, Issue is what about mid cap, small cap? Now, here is what we are with respect to mid and small cap. And in mid and small cap, when we are talking about the indices, I've gone with price to book. I have not gone with price to earnings simply because price to earning really tend to distort a lot. Now, mid cap, small cap, both are trading. The indices are trading about 4 times price to book on a trailing 12 basis. What happens during a trailing 12-month basis? If you are in this range, your past returns tells you that your returns tend to get compromised for a reasonable time, even 3 years, 5 years. So we are in this range, and history tells you that even your 3 year return could be single digits for the mid cap indices based on what valuations they are trading today, unless and until earnings take a significant beat. This again tells you about small cap. Again, a scenario we are trading above 4. We haven't got many data points when you're traded above 4, but it tells you that your 1 year, 3 year returns tend to be soft above a particular range. And that is what I am trying to sort of highlight here. So while Nifty returns, so just to sum it up, while Nifty returns, when you talk from the market context, on the market perspective, we are trading at marginal premium. There is an opportunity there to make reasonable returns. From a mid and small cap perspective, I think the returns could be softer over a year or two because entry multiples are not cheap. The other important point which I wanted to highlight is many a times, now look at this chart, So for example, March 15, the Nifty 1 year forward earning was 15 times. But the return 1 year forward was negative. Similarly, in March 21, okay, the Nifty 1 year forward earnings, we are not taking the COVID earnings, we are taking 1 year forward earnings. So based on that, we were 20%, but we did make 18% return. Next year, at similar valuations, we did not. Now, why I'm pointing this out is earning growth matters more than anything. If you look at this scenario, for the market as such, we were coming, and this is nothing but I've gone with EPS levels based on Bloomberg. In mid and small cap, because the earnings tend to be a bit volatile, I've gone with Bloomberg estimates of companies delivering positive earning estimates. And I've moved it across BSE 150, Nifty 150, and even Nifty small cap 250. This is 25, this is 250. What it tells you, now the important point, what it tells you is we were going through a softer period. Post that, earnings growth has been very good for the indices as such. Now, earnings growth, and this is adjusted basis over here, is expected to be a bit softer. Whereas for Nifty, the earning growth is going to come off, but it is not going to come off in a significant way. Why I'm highlighting it, this is today in a scenario where earning growth is going to be reasonably good. I'm not saying earning growth for mid and small cap is going to be bad, but the deceleration is going to be a tad higher. So given the context, given the way the scenario is today, I think it is better if allocation shift more towards large cap than mid and small cap. Having said that, earning growth continues to be reasonably good, and that is what we're trying to look for over here.
Understood. And looking at the percentile charts that you showed on the price to book and price to earnings, one observation was that median returns have always been the range of about 12 to 15, 10 to 15 kind of percent returns. Just that if the um, price to book is less than 1.6, and I think that would be a one-off scenario like COVID or something where the returns have gone up like 30 odd percent. But majorly the median returns have been in the similar range. And all I'm sure the trailing multiples would also indicate how the earnings growth from the sector or the market cap look like.
Valid observation. So when you're trading at a premium, you're near to, especially for mid and small cap, returns tend to get compromised. But over a period, you make those returns.
Right, right, right. Uh, and another question, Pranav, that people are having on the and I'm sure it's related to the valuations that we are looking at the markets. And there are also certain events that are coming up. We are looking at election result just 1 month from here. So how are you looking at the market volatility at this point in time? And how should investors allocate their money in these volatile times? What are some of the prudent ways to allocate money in the volatile times?
So let me answer it in two methods. One is, yeah, there are certain events which are coming up. There is uncertainty. So during bouts of uncertainty, my humble request is try to maybe take some profit off uh, set classes or things which have gone up a bit too much, and then try to maybe invest them at a time when there is more certainty. It doesn't mean you have to just go out of the market, but just book some profits temporarily and then just wait for those outcomes to come. At least that is how you tend to go about it. Uh, so, so within the pockets also you will get opportunities. Incrementally, what I also wanted to highlight, and I'll show you, so when we talk about volatility and events and some things, let me actually kind of take you through some of these things. So while investors' assumption, is more like this in terms of performance, what actually happens? is this: there is a lot of volatility, there is a lot of gyrations in between. You spoke about events. So I did highlight on the same chart that we have seen certain events, whereby which there has been volatility. You rightly put it, but what do you do during volatile times? So the answer to this is you will have volatile times. In fact, during the volatility, and when I talk about volatility, I mean upside as well as downside volatility. So during the volatile period, please be prudent about it, especially on the downside. One should be really, looking forward to it. Why? Because if during these volatile periods, so this is the scenario which actually happened, the GFC crisis and the market tank. If you would have made some investments there during this volatility, incremental returns should have been very good. So while near term one did face drawdowns, over a medium term would have made reasonable amount of money. Uh, I wanted to highlight this on another sort of things. This is a common thing which we come across. So when things do exceptionally well, we are, as an investor, including me, we are in a stage of thrill euphoria. And then the volatility, takes it down towards more of a fear, desperation. And this is the time when, as an investor, we end up, starting booking those losses or reducing our investments, and
Right.
we miss out on this period entirely. So we do miss out this. So we do get the shorter term benefit, but we miss out on that incremental returns. So my request is maybe take some profits where we are here and start trying to put some investment to use during these periods to make an additional alpha.
Absolutely. No, that's very beautifully shows up the investor behavior. And as wealth managers, we always try to control the investor behavior that you shouldn't be very excited from the short-term returns, and you shouldn't be very worried about if there is short-term volatility. And our belief is that the returns come from the asset allocation, not uh, and if you stick to your asset allocation, then you do generate good risk-adjusted returns in long term.
Absolutely.
Right, right, right. Um, Also, I saw some. Yeah, you have some more slides here.
Yeah, yeah. Yeah. So what I wanted to show was there was this interesting analysis which did here. So, so what you just talked about, I'm just trying to put it in picture, nothing else. So this has been a study which was talking about investment returns and investor returns. And the difference between two is this behavior gap. And there is a interesting study which happened, which was done by Talbers, with a quantitative analysis, and he did a 20-year annualized return for S&P 500. So we are not talking about just our investors; it is even for US investors, evolved investors. What one realized is for a S&P 500 for a 20-year annualized return, 45% of underperformance comes essentially because of investor behavior. And this comes from where? So if investor annualized return were closer to 8%, investors effectively got 4.5%. And the difference between that 8% and 5% or 4.5% was essentially this, where during this period of fear, panic, people actually sold off and they couldn't fathom it. And they eventually started getting in during the period of optimism and excitement.
Absolutely, absolutely. Oh, that beautifully shows up how what is driving the underperformance in investors' portfolios. So if you are sticking to your asset allocation, and then you would make good returns in the markets. Also, Pranav, I saw some slides on the sector valuations. So could you throw some light? And we have been seeing a lot of sectoral NFOs coming from different fund houses. So if you can throw some light on the sector valuations as well. Uh,
Of these charts essentially was that during the period of, when markets are expensive, what you tend to do. The first aspect to this is maybe invest in assets which are a bit, relatively cheaper, or where the earnings growth is still there, or the other way. So that is what you're doing is your slicing is based on, say, market cap. Like today, the risk reward seems to be more in favor of, say, large caps or Nifty, for that example, versus mid and small cap, because the entry multiple. Other way to look at it is try to invest in sectors or stocks which are kind of out of favor and where there is a chance of a revival. And that is also a way where if you can move your asset allocation, one can make an additional alpha. The point I'm trying to make here is, like today, the market seems to be expensive. Nifty seems to be trading at a premium. Uh, Almost a third of the Nifty is trading at a premium to which valuations, the 10-year average. But within this pockets also, there are certain industries like automobile, for example, they're doing reasonably well. And they are trading at a discount based on PE to their
Right.
medium term to long term earning. So similar goes to say private sector banks. Now, one I've seen where large many private sector banks and the bellwether of who's who perhaps have not given return to investors over 2 3 years. But
Right.
today, the valuations on a PE basis, if you can see, is now much below the mean. On a price to book basis, it is below the mean. So today, your entry multiples are not the same as they were a couple of years back, because they continue to compound, they continue to have this, and as and when things will tend to move ahead, probably the chances of you making alpha is much higher. Now, I want to give this private sector because understand the ROE tends to be reasonably good. Here, the ROE is still 15% plus. This ROE is closer or above the long-term mean. Now, there is another aspect. Look at these PSU banks. PSU banks today, on the contrary, are trading at a premium because they have seen that uptick. Those losses have become profits and ROEs have moved up. Sir, brush करायचं. Hello.
Hello.
If you look at this kind of a scenario, the same PSU banks, if you would have tried to invest over here or even here, one would have made a decent return because you were within the same market context, looking at an asset class which was not overtly expensive or was trading at a discount, and there was some earning uptick which is expected to. Now, this is the other way around within the banks. So one is the state-owned banks, the other is a private sector bank. Similar thing has happened. Now, so again, so part of asset allocation is probably move to an asset class or move towards certain stocks, whereby which there is a delta to earnings. Again, my point is there needs to be a delta to the earnings, but they are trading at a reasonable cheap multiple within the scheme of things. So within a Nifty as a whole, you will still see asset classes which are there. For example, cap goods, right? Now, cap goods today is trading at a significant premium. It is now closer to past highs, simply because they have been great order book prospects. Maybe continue to invest in them, but keep a note on order inflow, because that is something which will is driving that particular sector. Time one sees order inflow not coming for a reasonable time is a time when you move your asset allocation from this to certain sectors which is maybe seeing the and which is below the long term average. That is what we do as asset allocation. Because even in terms of the funds, I will request people to maybe think about this as well.
Absolutely. Absolutely. And wherein the expertise of the active fund management lies with, and you can allocate and move across the sectors which are looking reasonable and also generate alpha and control the volatility. Pranav, I have two more questions. One is if you can talk about more about your fund house, Canara Robeco Mutual Fund. It's a growing fund house, and we have seen good performance across the schemes. And also, you are a co-fund manager in the FlexiCap fund, and we have talked about the relative valuations in large, mid, and small cap. And FlexiCap fund has the flexibility to move across the market caps. So, how is your current allocation in the FlexiCap fund across large, mid, and small caps? So these are the two questions that I have.
So thank you for inviting us. I represent Canada Robeco Mutual Fund. What we are as Canada Robeco Mutual Fund, basically, we are a fund house which is 50-50 JV between Canara Bank, one of the leading banks, and Robeco, which is an asset management company based out of uh, Europe. Robeco Group is owned by Oryx Corporation, which is a Japanese company. So it's a 50-50 joint venture. Today, we have an asset base of about 1 lakh plus crores. Uh, as a fund house, we have been the largest one of the largest growing fund house over the last 3-4 years. Part to do is with the long-term performance track record which we have, as well as our relationship with lot many IFAs, banking channel, and other things, and the faith which investors have bestowed in us. Clearly, when it comes to our style of investing, we are growth investors, but we also consider quality. We have blend in our portfolios, but largely it will be growth centric, depending on companies which uh, are expected to compound returns over the longer term. Uh, we are not high momentum investors to that extent. And we do believe that currently, when they turn, uh, that is the style which will now start suiting us even more. So that is where we are actually looking forward. In terms of flexi cap, what we have done is while we've been stock specific when it comes to mid and small cap investing, predominantly the investments is in large cap. So that is what we have done. So asset allocation will be more towards large cap in the flexi cap fund. That is a call which we have taken. So we walk in the talk when it comes to the flexi cap allocation. So obviously there'll be some mid cap, small cap allocation, but incremental allocation is also moving more towards large cap.
Understood. Understood. Thank you so much, Pranav, for joining in today and beautifully addressing the concerns that people are currently having in the markets. And we really enjoyed the discussion with you, and we hope to do more sessions with you and your fund house in future.
Thank you for having me around and wishing everyone a safe time, sir. Thank you.
Thank you. Thank you so much, Pranav.